Welcome everyone. My name is Elizabeth Eaton. I will be the moderator for today's Zoom webinar. Our topic for today is How to Win by Not Losing, the first in our series of client education calls. Now, for some Zoom procedures and housekeeping. During the meeting, please refrain from pressing the Share Your Screen button as we will have a presentation shared for today's topic. You may turn your video on or off, which is located on the bottom left of the Zoom screen. I will have everyone muted for the duration of the meeting until we take time for questions and answers at the end. I would like to review our agenda for today. First, we will have Tom Shorn, Partner and Chief Compliance Officer, speak on his general thoughts. Next, Douglas Eaton, our Partner and Chief Investment Officer, will present our topic for today, How to Win by Not Losing. If any questions may come up during the presentations, please keep track of them. You will be given an opportunity at the end of the presentation to write them in the chat box, which is located on the bottom panel of the Zoom screen, or you can ask them live with your audio. Now, I would like to welcome our first presenter to the Zoom stage, Tom Shorn. Going to unmute you, Tom. Second.
Lizzie, did you just turn me on?
Yes, you're good to go.
Thank you. So thanks, Lizzie. Thanks everybody for joining, right? Do we live in exciting times? 2.5 months ago, we thought that life as we knew it was ending. Our markets, what we heard right there, weren't going to turn around for years. You know, my memory is the oil companies were going to start paying us to take oil off their hands. You know, when Dan, Doug, and I talk with our clients, you know, and you guys remember this day after day after day, you know, we talked about market movements from a historical view. Many times what we really heard was this time is different. And while I'm sure all of us, all three of us will always agree, yeah, this is different. It is not different in the fact, and we're seeing it right now, that the market will bottom, the market will recover, and the market will get back into new territory, right? And with that new territory comes all new time highs. We're not there, but one day we will be, right? What we don't know, right, are those very simple things, right? Today's call is really timely. I got to be honest with you. A client I've had for probably about a decade now called me today and had a question. And the question was, how come we didn't really do as well as the S&P 500 did in the last week to 10 days? My response was a question back, which was, how come you didn't ask me this when the market was down 35% or 37% where the top was, and your account was down 14 or 15, right? What I remember back then is we had our first conference call. Many I know of my clients did not look at their accounts until after that call, because when Doug went over what the moderate account did, and I don't remember the numbers, I think we're about 14% negative. People were ecstatic and there was a lot of happiness, right? So what I'm hoping here is that we really have more happiness in our overall performance, as we're going to look at some of that today, than the happiness of our accounts that were reduced only by 15% and not 35%. And so this becomes really timely, because we're already starting to forget. It's getting behind us, right? What was going on 3 months ago, 2.5 months ago? And we have to keep that, you know, in our mind as we're moving forward, right? And so I'm going to tell you how I answered this question. I said, well, we're not invested in the S&P 500. Very simple answer and a truthful answer, right? And I think what Doug's going to show you today, and it's going to be a real answer, the real answer, not my funny business answers, my smart guy answers. It's going to be, you know, intelligent, real answer to what I was asked today. I couldn't believe I got the question today. I said, oh my God, I've got what I'm going to say today. And I think as everybody sees this, and as we continue to go through the recovery, and look, the recovery is going to turn into great new territory. And then we're going to have another downturn, right? We like to call that a bear market. It would be nice if, we could all reflect back 2.5 months ago, all the way to today and what we hear today. So look, usually I have things I really want to talk about from, different perspective. Not a whole lot of new ground where I would normally talk. Very little, and I've talked to people out of effect. And so I don't really want to waste a whole lot of more time, and I'm going to either give it back to Elizabeth, or I'm going to just turn it over to Doug to get into the meat of today. I think this is great, right? How to win by not losing. Go back to the 35 versus the 14 or 15, and Doug can talk about those if he wants to. But I'll turn it over to Doug. Thanks.
Thanks, Tom. Thanks, Lizzie. And I also want to introduce, I don't know where everybody sees everybody else on their screen, but that handsome gentleman sitting there with the dark, light tie, Dan Mercado, other advisor in our practice. He's waving. And also, I was happy to see that the call is being recorded, because now we have evidence of Tom saying, I'm smart in public on a recorded line. So that was exciting. And thank you, Tom. That was great. Lizzie, we are recording, right? Yes. Okay, excellent. So good afternoon. And for those of you who never actually saw my daughter, Elizabeth, I know that some of you predate Lizzie and even predate my wife. So this is Lizzie, FSU student, hanging around with me over the summer. So I'm going to do a screen share now. And the deck itself is just a few slides, but I thought, it would be an instructive way to kind of make a couple of points. So just hang in there with me for 5 seconds while I get this going. Okay, how to win by not losing. So our topic is something that we talk about consistently with you all, and that is the notion of how to best take a measured approach with your investing. Where you don't experience what Tom was talking about, which is also known as FOMO, F-O-M-O, fear of missing out. Hey, the S&P is doing this, or the NASDAQ's doing that, and you get caught up in that discussion. Or most certainly, how to not experience a catastrophic failure of your plan. So we talk a lot about this, and this series of presentations that we're going to be starting today and continuing is how to take these concepts that we find incredibly valuable and making them very digestible and hoping that resonates with you. So with that said, we fully acknowledge that investment speak in some of these terms sounds like gibberish to a lot of people, and sometimes even to us. I listen to, sometimes people are making points about this or that, and they seem to want to intentionally use big words. So I thought that what we should probably be doing is, if we were to really make a point about the wisdom of X, Y, or Z, we make it nice and digestible and simple, and that's what we're doing today. And we're going to go on the assumption that if a majority of what we're talking about sounds like a riddle. So with that said, we're going to get started with our next slide. Now, so I first should say that for those of you who are used to watch TV from the 60s, this is Batman. That's Frank Gorshin, I think his name was. I know Tom for I don't know how many years, and I have never seen him take such pleasure in working on any project that I've ever done with him, as he took an interest in putting my face onto the Riddler. It's safe to say that he, along with his accomplice in that other room over there, Lizzie, spent no less than 5-6 hours scheming and giggling about this little project and getting the face exactly right. So there we go. Look at him, look how happy he is. So if that's all it takes to make Tom happy, that we got to do one of these decks every week, because that just warms my heart. So with that said, our topic for today was the inspiration for this, and that is, there's an investment axiom that is really important that does sound like a riddle. And that is, half of the up and half of the down get you all of the up with only half of the down. Now I'm going to say that fast. Half of the up, half of the down, get you all the way up with only half of the down. So essentially, in the real world, from a clearer presentation of the concept, we want the portfolio to capture the same return, but with approximately half the volatility. That's what we seek in our moderate models. And there's a lot of math to it, but there's a lot of wisdom to it and a utility in your financial plan. So what we did for this first part of the presentation was we picked out a time slice. And the time slice was when the dot-com burst and, back in March of 2000, and we wanted to show what that looked like over a 20-year period and the tale of two portfolios. So up here in red, the S&P 500, and of course blue. That's blue, right, Lizzie? Yeah, blue. Okay. It's dangerous for me to start talking about colors. That could have easily been purple. So in any event, red and blue. And we're going to show two portfolios that do two different things. And this also obviously goes to what Tom was talking about a little bit. So number one, we have the S&P. Now you got all of the up and all of the down. So here's the S&P starting in March of 2000. And it almost immediately drops 48%. Now, for those of you who are out there doing math and you have a calculator, or you just choose to take my word for it, that 48% would then take about 93% to get back up to where it was. So if you take that $52,000 and bring it all the way up to the 116, which we see here, that's 123 or 124%. So you get all of the up and all of the down. So we went back up, and then look at this, we went back down again. And then you had a pretty good run here. The ending value was $310,000, so you did okay. You had to hang in there for 20 years, but I want you to think for a second how you would have felt if this was the beginning part of your retirement. Now, half of the up and half of the down gets you all of the up with only half the down. Now, this is the moderate portfolio. Now, this is essentially our 65-35 or our 60-40 portfolio, depending on where we are. This is what's called the moderate portfolio. So in blue, what you see here is 100 going to 75. That's a 25% drop. And you could see that over the course of this 20-year period, the S&P never really catches the moderate portfolio until the end, until there's a dead run. And the primary reason for this is you have to come back from such extreme lows mathematically to catch a portfolio that hasn't dropped off. Now, before I go to the next slide, the other part of the point that's very relevant is that imagine you are in retirement and you start retirement at this point. And we make an example of $100,000 being your pool of money. And we also make the example, which is a very real world example, that you're taking out 4% of your portfolio per year. Now, 4% of a portfolio starting with 100 grand is $4,000. And we've established that you need $4,000 a year to live, okay? Now, here's the problem. You have a portfolio that drops 50%. You have a 50% drop, that turns the 4% into 6%. Over a long period of time, that would put the portfolio under a great deal more pressure and vastly increases the likelihood of a portfolio failure. So the sequence of this return, this downturn so early on in the plan, is a problem. So the other utility, besides the speed with which you catch back up, is also something very real with respect to cash flow planning. Now, I know that you may have a question or two here. I want you to make a note, and please ask it. But I wanted to make this as straightforward as possible, that there is no real reason to take big chances in a portfolio like this, because very simply, at this point right here, it doesn't mean we're just sitting there also. 25% down, we're buying stock as well. So your break-even point is just much more compressed. So now, we're going to move forward. And for a little more perspective, let's look at a real world scenario. And I'm not going to get into our portfolio performance today. I thought I would address it here. And, you know, we are scheduling reviews with all of you over the next several months. That's, you know, Tom, Dan, and I, and we'll talk about specifics. But I thought it would be fun to see graphically presented what this really looked like since February. So our history. The S&P dropped 33 percentage points from February 19th till March 23rd. Now, I don't want to get into the chart. I just want to set this up. These are real world numbers. It came back 37% through May 29th. You know, clearly I did this slide last week, and, you know, it moved another 4 or 5 percentage points. But it came all the way back. Now, once again, keep something in mind. This 33% needed to come back 58%. The S&P has still not yet come back to where it was on February 19th. We've seen this astronomical move, but it hasn't come back yet because of the math. Now, our model, as of March 23rd, was down 19 percentage points. It only needed 23 percentage points to come back. So here's your time frame. Here's the S&P. All right? That's March 23rd of 2020. These are real numbers. Here's our moderate model. We're still ahead of the S&P. Now, clearly, you know, as Tom discussed with his client, we don't take all of your money and put it in the S&P 500, but we obviously need something that's familiar for you to have a frame of reference to evaluate what's going on in your portfolio. And certainly the three of us talk about, you know, this benchmark a lot, but as you can see in this very, you know, compressed time frame, this is real world stuff. So we'll keep moving forward. Now, in terms of changing directions here, I've talked to you about what I'd like you to focus on. And certainly we should talk about this. We should talk about it, you know, in a review meeting. Is this relevant in your world? Does this work for you? And so on and so forth, and talk about real numbers. But there's another part of the perspective, and that is, while you're looking at this chaos in the world, what does that really mean in terms of what you should be focused on? So the next slide is a very short video that I want you to watch. And I'm concerned that the sound isn't going to come through that's telling you what to look for. So I will tell you that it's people tossing a ball back and forth. And I want you to count how many times the ball is tossed back and forth from the people in the white shirts.
Attention. Count how many times the players wearing white pass the basketball. How many passes did you count? The correct answer is 15 passes. But did you see the gorilla? Attention.
Okay, simplistic, right? A little bit of fun. I thought it was funny when the gorilla went like this. So, you know, I thought he should have strolled through, would have made the point a little bit better. But in any event, what we talk to you about is perspective. What we really want you to think about. Now, as human beings, we have myopia. We focus in on what we want to focus in on. And a lot of times it's based on fear, sometimes it's based on greed or passion. But Tom and Dan and I, we're myopic as well. And what we want to do is we want to teach you and counsel you with respect to our advice on what you should be focusing on. The shiny objects that certainly are on your mind are trade wars. geopolitical concerns, economic worries, social unrest, the events like COVID-19, things that pop out of nowhere, et cetera, et cetera, et cetera. And you know what? They're important. They're important because they are on your mind. Their relevance in your financial plan is minimal. You want to talk about, social unrest with your liberal brother-in-law at Thanksgiving or COVID-19 with your extremely conservative sister-in-law at another holiday party, have at it. We think it's a great idea. It has limited value in your financial planning. The reason is that you have a financial plan that's based on your reality, that's long-term, with different silos of money and insurance and cash flow planning for a reason. And the reason that we like to counsel you on is that it is all within your control. Our advice is based on fleshing out with you who you love. Who you love is really your why you do your financial planning, understanding your values. And when we say your values, it's what in your life is more important than your money. Asset allocation, how much in gold, how much in bonds, so on and so forth, diversifying. Consistent investment of new money when you have it. Ongoing review of your financial plans. That's the most important thing. That is our perspective. This is what we want for you to stay on track. So our focus is on ensuring that your aspirations and your values and your goals and your financial assets are all congruent, and then assist you in keeping them on track. So with that said, I am going to close the screen share, and I think what I want to do is I'm going to jump into just a couple of comments on the portfolios, and then we're going to hit Q&A. Okay? So, a second here, my notes shut down. So, we were talking a lot about what was going on in the portfolio and taking this measured approach. And one of the things that we had been working on in the portfolio was taking a look at things that were, really unfairly bruised up, sectors that were knocked around. And we talked about this in our previous calls, what we were putting into the portfolio. And I wanted to touch on that because I thought it was kind of relevant. So, number one, last week, I think you got an email from me on Friday afternoon that we spent Friday late afternoon taking significant gains from our winners. We did not sell the positions, but when you have a position in a very short period of time that moves anywhere from 25 to 50 or 60%, it's prudent to assume that's not going to continue to run indefinitely, and we take that so we can divert that into something that may be out of favor. As you probably know, in an IRA account, there is no taxable gain, and in just about every circumstance in the practice, we have losses for 2020, so we're able to offset that. So a couple of weeks ago, we opened up 2 real estate positions. Real estate, as we know, is really a problem in terms of how to analyze what's a safe space, but we purchased a company that essentially stores data, destroys documents that are no longer needed, and it's essentially what amounts to a server farm for data protection. It's called Iron Mountain. We also bought another REIT as well, that a real estate investment trust that is just involved with self-storage, that we felt is a place that's poised for growth. They were up about 25, 26% in a couple of weeks. Energy. As Tom alluded to, and as we mentioned a couple of calls ago, there was actually a point in April where if you wanted to own oil, you could actually take money to own it. Oil went negative. The price per barrel on the spot was about $10. So on that day, we actually bought oil itself, and we also bought Exxon and Schlumberger. Exxon during that last several weeks is up about 30%, Schlumberger about 55%, and of course oil has made a movement up about 280%. Gold, we added gold a few weeks ago, essentially as an inflation currency type of trade. It's flat, it's up about 1% or 2%. And then finally, leisure. We bought Disney and Hilton. We bought those in late March. Both of them are up about 14%. And I'm pointing this out just simply, look, as the old saying goes, it's better to be lucky than good. Every single stock in the S&P 500 is up. So, I don't deserve a Mensa pin for guessing right. But I think that with respect to these positions, these were a little, they were a little outside of our lines in terms of what we typically put into the portfolios. So we did spend some time looking at things that were unfairly beat up, that had a different type of risk profile. But once again, we are going to take some of the gains out so we can smooth out the ride. Now, I'm going to end by saying, and as a reminder, a fool's errand is to feel that our value proposition is to chase the indexes around. We don't want to talk to you all the time about what the index is doing because it's not what we do. Our job as a fiduciary is to provide advice and make sure that your financial plan just simply contains different silos of money for when you're going to need them, and the plan is relevant with your life and your lifestyle. So the end game is you do not have to sell assets at the exact wrong moment for the wrong price. And that's essentially our construct, our narrative with respect to this whole entire presentation today. And hopefully this made some sense. I hope you have some good questions for us, and if not today, as you know, we're always available. So Lizzie, why don't you open up the lines for questions, and we'll take a look at the chat.
So if anyone has any questions, please feel free to send them in the chat box. Doug or Tom will get to them, and we'll try to answer all your questions from today's meetings. Or if you would like to say them live, that would be great as well. You can use the raise hand feature. So if anyone has any questions, you can send them over our way.
Doug, so while we're waiting, I'll continue on with my discussion today, right? And I went into what my true thoughts for most people are, and this is going to be about 95% as I see it, is that 95% of the people really belong in moderate, right? Exactly what you're talking about. And my reasoning is 99% of the people cannot accept and can't handle an aggressive portfolio and the movements in it, right? And as we look at conservative accounts, and even though that gives you a nice warm fuzzy feeling when the markets are going down, it feels great. Overall, there's just not enough return, right, to offset inflation after tax. And so it's always been one of my positions. Hey, I think everybody belongs in moderate. Now, we don't have everybody in moderate, of course, because some people really are conservative, right? And some of our clients really are aggressive and can handle it.
Yeah.
And so, that's how
I think that, at some points, during March, I think the only positions a lot of clients would have wanted, really owned, the only positions they would have been in is cash and fetal. And, on the other hand, it did reveal, as you and I talked about in late March, that some people in a model didn't have the tolerance for that type of volatility. And it is incumbent upon us to really understand that.
Right. And so, as you know, right, we are now starting an entire redo of measuring risk with each client, right? And we kicked that off in our office this week. And so I know that you're probably doing the same, maybe on a meeting by meeting basis. We're going to do it pre-meeting, and my son Tom, that everybody knows, is really leading that. And so, we're actually going to we think this is a great time for everybody to look at the risk, look at where you measure. Let's look at where the portfolio is, and let's look back at March and say, what happened then, and how did you feel, right? And I'm sure everybody on the call can remember, and you and I had this conversation the day before, I think the first conference call. I was on the phone 15 hours that day, scheduled. Yeah. Unscheduled, probably another couple hours, right? And so, and I don't think that would change by measuring risk, right? That's just a normal occurrence. But I think that measurement of risk really gives them and gives us a way to say, yeah, we're in the right spot. Maybe we're not. Maybe we need to do something a little bit different. And so I think, one of the things that, people should realize as we get through the next month, maybe 2 months, that this is probably one of the things that we're going to run into with you and have these conversations and try to determine, are we doing exactly what's right in your situation?
It's a great point. Tom, I know you have some experience. You're involved with different boards, hospitals and things like that in Pennsylvania. What you reminded me of just now is that when you have a diagnostic exam, when you have an issue, medically speaking, and then you have a procedure, you also need another diagnostic exam and follow-up afterwards, just to make sure that the fact patterns are the same, that everything is the same as we believed prior to the procedure, right?
That's right.
So I think that when you're doing a risk tolerance exercise with somebody, and then there's an event, and this event, let's just call it a shock to the system, there does need to be another evaluation after the fact. And, I think it's relevant. I've used this before, and it's not always the most popular line, but, Mike Tyson has this great line about this. And he said, everybody's got a great fight plan until they get punched in the face.
Mm-hmm.
And you got to really think about what it is that you're comfortable with.
Well,
so, great point,
right. And we all think we're healthy until we find ourselves in an ambulance, right? And then we know we're not healthy. Right. And so, we all should go and do those things. And the same thing's here, right? We go do with our doctors because, it's our health. And hopefully everybody on the call, and my clients now, I'm all over them, right, to keep themselves healthy. Otherwise, I start to lose clients, and I'm not happy about that. Right? The same thing happens with us. Here we are, right? When the markets feel good, the amount of people we're dealing with gets smaller and smaller. Shouldn't be that way. It should be exactly the same way prior to getting in. This is work that takes 365 days a year, not just maybe 90 in this latest bear market, right? Which is the shortest bear market ever probably, right? And then it turned around and became a bull market. Standard bear market somewhere around 35 months, I believe. Not 100% sure that's that. That's a long time. If we go back to 2008, 2009, and let me give you the exact dates: October 2007 to March of 2009, I believe it was March or April. Kind of ended it, right? Bottomed, right? Long time, much more. It hurt clients much longer. This one didn't hurt as long because it wasn't as long. The trajectory down was worse, just didn't make it as far, but it was a much shorter downturn. And so clients have backed off kind of already, which we'd like to, personally, we'd like to see clients not back off at all. Important that we're staying in touch. We're doing these different things that we have on the schedule, right? And look, none of this stuff comes easy here. We go over this. What are we going to do? It's a constant thing that we're doing, right? And so people are going to see some new stuff coming out, right, from this risk tolerance, right? Much more convenient, much easier, but much more important too, right? And here's one of the things that Doug and I spoke about early on. And so, the savior of this was Doug, right? I got to give him the entire.
Are we still recording?
Yeah, shut the recording, Lizzie, while I say this. We had this conversation. I said, Doug, I don't think this is a big deal, this virus thing. And Doug did not agree with me, thankfully. And the one thing that we kind of looked at right after that was, hey, everybody's 12 years older than the last bear market. They can't handle it like they could 12 years ago, right? We usually don't get, 25-year-old clients. My son, who's, everybody knows him that's in my practice, he'll get the 25-year-old clients. My clients are, older, and they can't handle what they could 12 years ago. And so the fact that we sat and we talked and this and that, and I really never go against Doug's opinion. I got to be honest with you. And it's for a reason, right? Because he's a smart guy, close to me, but He's a smart guy. It was a great call by him, and it was great that we're able to go back and forth, right? And so here we are. We got through this very quick downturn. People should not be used to this. We should be used to, and when I talked about 35 months, that's the actual, top, not end to bottom, and to recovery, to where we hit the indexes come back. We haven't done that yet, but yesterday, where were we? 27.5. I didn't look at the close today, so we're somewhere around 27, I'm sure, right? So we got 2,500 more points, less than 10%. It'll be a quick, full recovery, in my opinion. Doug will probably call me afterwards and say no, and I'll have to agree with them. But this is much different. So everybody doesn't feel as bad. They felt horrible, right? Does everybody remember their feeling in March? Because I do. I remember the feeling. And I remember those 15-hour scheduled days. And, here we are coming back, and it feels great. And that's why I said, hey, don't we live in exciting times? I mean, this is exciting to come back this quick. This really is exciting. It's exciting for me. It's exciting for all the clients. But let's not lose what we should be focused on. And that's a consistent look, a consistent plan, a consistent conversation, right? With me, Doug, Dan, right? Let's make sure everything's still right. Just because the markets went up doesn't mean everything's right. We may still have some adjustments we need to make based on our discussions that we're going to have with you, right? And so I know when we're putting out, our risk tolerance questionnaire, it's going to come via internet, via email, very simple, very easy. I know Doug's doing it. I know Dan, I think, is about to start doing it, right? Let's make sure we're taking the time. I know in my office, we're not letting anybody off the hook, right? We want everybody to do it. And we did one this week as we are testing, right? We're testing right now, and we did one, and it doesn't match. The match is a little bit over what I would say is an acceptable difference. And so that's going to lead to a conversation at the end of the week about where the client really wants to be, right? And so we have to have those conversations. So when everybody stay focused, don't only focus when it's going down. And look, we love what we did here, right? I looked back to how we did this in February, March, and April, and I looked back to 2008 and 9. This was much more acceptable for clients and much more acceptable for me. I really enjoyed being there for the client, right? And I'm pretty sure I'm speaking for the other two. We all enjoyed being there for the clients. We did what you wanted us to do and what you expected us to do, and that will never change. So as all three of us has huddled together here, we're on this call because we said, these calls were very useful. Clients loved it. And so what we want to do at this point is keep moving them forward, not on a weekly basis, but on a monthly basis. We haven't determined, we're talking bi-monthly, monthly. I would say probably let's talk monthly and have topics that are not, hey, if you guys remember the calls, look, here's where we think the markets are going to go. This is what they're down. This is what your accounts are down. I mean, we were very focused on a very slim area of what we do. And now we want to expand that area and get across, some topics and some knowledge and things that each one of us have, that if we can do it in a structured manner like today and get it across to a lot of people, very useful. And so we're planning on doing that. We don't know the exact timing. I know in my head, this is the first time Doug and Dan will hear this, will be on a monthly basis on the second Tuesday of every month. And as Doug did say earlier, I did enjoy putting this one together with his daughter, who her and I were just laughing as we put his head on this Riddler, which is very funny for us. You know, and it's something that we really want to do. And we really want everybody here, all our clients, to benefit from, look, we have a lot of knowledge here, right? I mean, I'm sure you guys all respect Doug for what comes out of his mouth every time he's on the phone with us. I call myself the farmer. Like, I talk like a farmer, right? I have a lot more education than Doug, but I still talk worse than him. He's a smart guy. You know, I've got a lot of knowledge. Dan has a lot of knowledge. We want to use it, right? And help our clients, right? We want you to be successful. That's what this game is for us.
Good job. Thanks, Tom. So I'm going to make one last comment and see if there's any questions, you know, and just say to you this. We don't know the next 25% move down, when it's going to happen. But what we do know is where the next 100% move will come. And it's not going to be down, it's going to be up. We don't know when, and we don't care when. What we care about is the long-term upward trend of equity. And that's what happens. And that's what we're playing for, and that's what we're going to continue to play for. And I will say that one of the really great things, you know, that I experienced in the last several months was, you know, and Tom experienced the same thing, is neither one of us really had true partners back in 08, 09. And Tom and I would get on the phone almost every day, and it was almost unnerving. It was a very business as usual conversation. Tom would ask me what I'm doing. I would ask him what's going on, and we would just kind of talk about what's going on during the next day or so. Because none of it was shocking. It was just things that happened. And the point I want to leave you with is this time is never different. There's volatility, and as a rule, we are going to have volatility. And we embrace it. And we exploit it like we have. And we continue on, and the world turns, and that's the end of it. So, Tom, I'm going to let you finish. I don't see any questions from the group. I'm going to let you end for us, and then we'll say goodnight.
Thanks, Doug. So, look, I'm thinking back right now, and I'm sure everybody on the call remembers this. I've said a couple things back in the day, and that day was just a few months ago. One was turn the news off, et cetera, et cetera. And the one thing that I do remember saying was, go do what you enjoy. All right. So I got to be honest with everybody. Tonight, I'm going to do the same thing I did back on, I'm going to say we had that call March 24th. It was probably a week or two after that. On our second or third call, I said, I'm going to go do what I enjoy. And that's ride my bike down to the beach and watch the sun go down. Right? And that's what I do. And it doesn't change from that point to this point. I'm going to do exactly the same thing because, you know, I'm happy to be here. Right? I'm happy that I have these great people that I work with. And I'm happy to have these great clients that I work with. The fellow that I talked today, he's been a client of mine for a decade. He's one of my favorite clients. And I told him I was going to use his question tonight. And it's just, I have such a great life surrounded by everything I'm involved with. And there's no reason for me ever to change what I do. I know things are going to go bad. We've all seen it. We saw the markets go down. For those that live in a city, you've seen it get, you know, beat up recently. I'm still going to take my bike tonight, and I'm going to go watch the sun go down. I'm going to talk with a couple of people down there, and then I'm coming back home. And that's just the way I'm going to finish my day. It's going to be exactly the same. It doesn't change for me. When I look at the market, it doesn't change. And I'm going to suggest that it doesn't change for you. It's a tool that we use to make retirement possible for you. Because we can't make it possible with CDs. If we could, we would, and everybody would be in CDs so you don't go through the downturn. But it's not possible. So with that, I really want to thank everybody for taking the time tonight. Keep your eyes open. We'll be having this conference call, most likely the first Tuesday of July. And the only way that won't work if it's July 4th, and I don't know if that it is or it isn't. Should have looked before I committed to the second Tuesday. No, we said second Tuesday. It's a second Tuesday, so it won't be July 4th. So it will be the second Tuesday. And I look forward to seeing everybody. And look, the question that this fellow asked me today, I think everybody should be asking that question of us. Why this? Why that? Why? It only helps us, and more importantly, it helps you. So with that, I'll let everybody go. Doug, thank you again for such a great job, and I want to welcome your daughter, who's just done a tremendous job on what you got to show today. So thank you, Lizzie. And Dan, I know you haven't said anything. You're very quiet. Thank you for what you've done for us, all three of us, and your clients.
Good job.
You've done a great job.
Good night, everybody.
Bye.